Well, it's 6 o'clock, so I'm going to go ahead and get started with tonight's class. My name is Maria Young, and I'm going to be co-teaching section BB404 along with Marcus Reed. He's the attorney who's speaking a lot about the finance section of it, so raising capital, and then also he'll be talking with you about licensing, compliance, and those issues. I'll be focusing more on the accounting side of things. And tell you a little bit about myself. I'm a CPA, and I focus primarily on the brewery industry. I have clients that are brewers, cideries, also other businesses that cater to the industry, like a hop farm and a mobile canning company, so keeping it pretty close to the core of breweries. I run my own business, and I offer contract controller services. So basically what that is providing someone who can run your accounting department for companies that are too small to have someone on staff full time. So that's my role. And today we're going to talk about cash flow and SBA loans in particular. And my guest is Kathy Pickett. Kathy is with US Bank, and she's a loan officer that specializes in SBA loans. So that's on the agenda for tonight. And Melly is here. You'll see I'm signed in as Melly, but she's here over on the side of the screen. And she'll be are these guys in your 7 o'clock class?
No, they already took it.
Okay, well, never mind. But she's here for moral support. But we're going to go ahead and get started. I'll talk a little bit about the introduction to the materials and touch on some of the aspects that you'll see in the recorded video that's assigned for this week before we start getting in depth to the SBA loans. So you've got all your ducks in a row, you've built your business plan, you've got through your profit and loss, you've priced out your goods, you know, sort of what the pricing structure looks like. So to take that to the next level and really go live, the big elephant in the room is sources of funding, because you've got to have, you know, enough capital to buy the equipment that you need, get into the space that you need, and to get going. And that's one of the things that's a real barrier to getting into this industry is it's so capital intensive. You've got to buy a lot of equipment before you can ever start to make money. So how do you get that capital? There's three ways you're going to do it. You either go into debt for it, you sell equity in your business for it, or you have to pony up the cash on your own. So if you have debt, that means that you've taken a loan from someone else and then you pay it back with interest. And usually that loan's going to either come from individuals, or so people you know, maybe family members, other individuals in the community, or it's going to come from institutional lending, which is a bank, or possibly a government agency. Our government has programs in place that are designed to get the economy up and running and producing at full speed, and so they help fund startup businesses. So debt from one of those three places. If you're doing equity, then that means that people are giving you money in exchange for a piece of your business, a piece of ownership in your business. So when you're going about raising your capital and you figured out whether you want to approach someone for debt or someone for equity, you have to give them some sort of idea of what they're getting themselves into, what the plan is for the future, and basically giving them an idea of the horse that they're betting on, how you're going to do down the road. So you do that by providing financials. And the financials, if you're a startup company, you're going to put together what we call pro forma financial statements, which is prospective. And it's kind of your best guess as to where you're going to be in the future and what that performance will look like. If you're an established company, then you're going to provide historical documents. Maybe you provide the last 2 or 3 years of financial performance, and then you also probably are going to provide prospective statements as well. And one common scenario where an established company might find themselves in this place is, let's say, you know, you've been a successful brewery and you want to open a production facility so that you can expand your production, but you don't have the space where you are now. You're actually going to have to maybe buy a building, or if you're going to lease space, then you've got to buy a whole another set of equipment. So that could be a situation where an established brewery needs to go out and get funding to take their business to the next level. So anyway, kind of got off on a tangent there, but a complete set of financials, anyway, when you figure out what you're going for, a complete set of financials is given to prospective either investors or lenders. And complete set of financials includes a balance sheet, profit and loss statement, and a statement of cash flows. So in previous classes, you've talked a lot about balance sheet and particularly the profit and loss statement, but we haven't really delved into the cash flow. So that's one of our focuses in week 1. In the recorded video that you have access to this week, I really dive into the statement of cash flows, what its purpose is, how it's used, and I introduce you to the concept of it being the link between the balance sheet and the profit and loss statement. One thing that I hear consistently from business owners is they take a look at the P&L and they're like, well, the P&L says that I had a really good year, but I sure don't feel like I have any money to show for it. And they're trying to figure out where that money went. Well, a lot of times if you take cash and use it for balance sheet items, let's say you buy new equipment or you pay down debt, those are all things that use cash, but they don't affect the P&L. That goes on the balance sheet. And that cash flow statement is going to show you where the money is used in your business. So I could go on and on about this because I love this stuff, but I'll just leave it at that. Go watch the cash flow video. One of your homework assignments is to prepare a cash flow statement by month over the course of a year. And first thing, watch the video. Second, on the homework, the first tab sets up a scenario for you, and hopefully with the knowledge that you gained in the video, you should be able to complete that. I've also provided given information, which is a balance sheet by month for a year and a profit and loss statement by month for a year. So you're going to take those two pieces of given information and then fill out the cash flow for the month or for the year by month. Okay, so that's cash flow. Definitely contact me at any time if you have questions about that. It is passion of mine, and I'm happy to talk about it at any time. But once you've got those financials put together, and let's go back to the scenario of approaching a bank for lending. So you're going to provide a set of financials, and one of the most important ones that you provide is the statement of cash flows. So this is where we start to talk about the types of loans that are available and why a bank cares about your financial statements. So Kathy, do you want to maybe just introduce us by talking about how a bank uses those prospective financial statements, what information they're looking for, and particularly how they view the cash flow statement?
Well, it's going to actually depend if you're actually going to be a startup business or if you're already in existence. So if you're in existence, most of the time we want 2 to 3 years of your tax returns, profit and losses, and balance sheet. And then if you're a new business, we're still going to request the same things on a personal level, but then we would like to see a business plan. So we want to see an individual, so line item, explain to us how you're going to make the money and over what time you're going to make the money. And then even better, if you get a loan with a bank, how quickly can you repay that loan during the year? Or are you just going to be pro forma and not make any money to pay that loan during the year? So all of these things go into a lot that the banks look into.
And then I want to also kind of introduce the concept of an SBA loan. If you're working with a bank, there are, you could go to a bank for a traditional loan, which is fully funded by a bank, or you could work with them to get an SBA loan. So the SBA is the Small Business Administration. It's one of the government agencies that I mentioned in a previous slide, and it's there to help fuel small businesses across America. And it helps out in several ways. It helps out with just general resources, but then they also have this loan program specifically designed for small businesses. So tell us a little bit about that program.
So the reason why the government came up with this program is to actually have the banks want to encourage them to do higher loan to values. And it's not as risky for the bank because the government is backing 75% of that loan. So what they're looking for is they're making sure that we can go with a little bit skinnier. So if you don't have the financials to support it completely, we can go with lower loan to ratios. So like every dollar that you make, we want to see you make $1. If you went conventional, every dollar you make, we might want to see have you make $1.40 or $1.25. So by going SBA, that allows us to go with the lower cash flows.
So can you explain a little bit that idea of loan to value and what that concept is?
Absolutely. So the loan to value is going to be depending upon, most of the time we're going to get an appraisal, and we're going to do either an appraisal on your business plan, or if you're already in existence, we're going to do a true appraisal. And just to kind of give you an example, the appraisals cost about $2,500. So that's one of the fees that you would be facing if you're already pre-existing. So, and that by that appraisal, we will lend depending. So for breweries, we're going to go up to 75 to 80%. And it's just depending if you're only selling brew, as far as beer, or if you're also doing a restaurant.
Okay.
So if you're doing a restaurant, you're a little bit more risky, and so they will actually drop it down a little bit. So.
And that risk is just determined based on historical knowledge of an industry as a whole.
Correct.
Like banks would look and see how many restaurants have defaulted versus how many breweries have defaulted.
And actually, I'm at 85%, or I started to go conventional there for you. I apologize. So it's actually 85% if you're only selling beer, and then it goes down to 80% if you're at a restaurant.
Awesome. Okay.
Just realized what I said.
Okay. Let's see. Have we talked about everything we need to here? Let's see. SBA loan.
So we can do loans all the way up to $15 million. When you're a startup company, you're not going to get a $15 million loan. You're going to get maybe a $500,000 loan when you first start up. So, don't be discouraged if you're just starting your brewery and we're saying, the banks are saying, oh, no, we can only do $500,000. That's a really good loan at $500,000 to start up. Now, once you're already in existence, then I would hope that you can make up the higher amounts.
Yeah. Okay. And let's see, these last two bullet points that we're looking at on this slide, the owner-occupied properties and commercial real estate transactions up to 11.25 million, and that's primarily for real estate focused loans.
That's correct. That's for when you get ready and your brewery becomes big enough and you want to buy your own building. We always look at owner-occupied, so we want you to occupy at least 51% of the building.
Okay, great. And then the 7A loan is a different type of loan, or one of the types of loans offered by the SBA.
So the difference between a 7A and a 504 is 7A, we're going to, as a lender, go ahead and do the whole amount, and the whole amount is carried in-house. And there are certain banks out there that are preferred lenders, and there's other banks that are not preferred lenders. So for an example, the bank that I work for, we are preferred lenders, so we keep everything in-house, even the government loans.
Okay.
So for the 7A, we can go one loan, and you'll only have one loan with whatever bank you go with. And then if you go 504, that would be two loans. And generally, it's broken up where it might be 25% where the lender's carrying it and 75% where it's the SBA guaranteed by the government.
Okay. Let's see. So I want to touch on a couple of these points. So we talked about the owner occupancy rule for these loans, the guaranteed loan amount up to $5 million. Tell us about that.
So SBA has caps as far as how much we can go. So $5 million is the maximum SBA will guarantee. So if you
for one particular
for one entity,
okay.
one loan.
Okay.
And we have terms up to 25 years with all SBA lenders, and that's only on real estate. Now, if you're going with non-real estate, the maximum amount any lender will do is 10 years.
10 years. Okay.
So because there's no real estate involved.
Okay. And the loan to value of up to 90% for purchases and construction. So that construction would be tenant improvements. If you have a building and you need to build out the space, then you can finance that build out of the space.
Correct.
Yeah.
That's
okay.
correct.
Okay. And then help me with this. Pre-PASU 7A projects.
That's so wonderful. That's the name of the program, actually. Believe it or not, it doesn't mean anything special, but it's a fancy name.
Okay, so projects up to $7.5 million are sort of in a different tier. Yeah. Okay. And then the 504, that's a different type of loan.
That's the loan where you have two loans. So where the bank will carry one part of it, then SBA will carry the second part. Now with the preferred lenders, they actually in-house both. So you will have the loan with the lender and you'll have the loan guaranteed through the SBA department, then the bank will actually service both of them.
Okay.
And so you'll only be paying directly to that bank.
Okay. And just to reiterate, down there at the bottom of the screen, that LTV, that's loan to value.
That's correct.
Yeah.
Now, if you have a loan with a bank and you need to get a second, the SBA can do a second. And then, of course, if you don't have, the other great thing about the SBA loans is if you're uncollateralized, a lot of businesses, when they first start up, they're not going to have the money. Will actually secure it as on your home, basically. So they do either a third lien position or whatever position you have available, and they'll tie it to the SBA. So then once you hit a 1-to-1 ratio of those things, so every dollar that you make, you are spending the same amount, then SBA can actually go back in and take that loan off.
Oh, that's great. So that's great. So that would be a really great way to get started if you need to kind of get a bigger, if you need a loan right away and maybe the loan to value isn't where it needs to be, you can put up your house as a collateral piece, and then as soon as your loan to value gets in line with where it needs to be, then you could take that house out of the equation.
That's correct. Okay. And then also, when you've had it long enough, you can take the SBA loan and make it into a conventional loan.
Oh.
So that is something that you can do later on. You just need to find out what days you can pay it off, because there's certain days or times of the year that you can pay it off based on your lender.
Okay, great. SBA Changes. So the process has changed recently.
Process changed recently. For some lenders, if you are a preferred lender, you can get a loan done between 45 and 50 days.
Wow.
And that's if it's non-real estate secured. If it's real estate secured, you're going anywhere from 60 to 90 days. And so a lot of things have been streamlined. Now, if you find a bank, and your big question is, when you go to find an SBA lender, find out if they're a preferred lender or if they're a non-preferred lender, because that tells you whether or not you're going to have a quick turnaround time or not. And the nice thing about going with somebody that knows what they're doing and has been doing it for a long time is that they're up to date on all the new SBA process changes.
Yeah.
So you don't want to go and have a lender that, you think is a great lender, and then you find out that they really haven't been up to date on the process changes, and you get halfway through your loan falls through.
So how would somebody know if a lender is preferred? Is that something that's advertised on the website, or is it something that if you're looking for a loan, you have to explicitly ask that? Or
I would say I would ask that question directly of the lender, because I'm sure they're not going to tell you they're preferred if not. And generally, the preferred lenders, they keep them in-house. So if you're speaking to someone, they say they don't keep it in-house, then you may not have a preferred lender.
Okay. And give us some sense of, with this streamlined process, how is that different than what it was before this change, like time-wise? How long did it used to take versus the 45 minutes?
It used to take
45 days.
I know, too bad. It's okay. We're all tongue-tied over here.
Yeah.
So it takes about, it used to take 90 days or longer. It really used to take a lot longer to get something done.
Wow, so it's cut that time in half.
And Ben has a question. He was asking if he can put up his house as collateral and take a loan for his corporation. And you can through SBA, but if you were going any other way, you could not, because they don't like you to cross-mix and the property with the business. So only SBA is the only type of loan out there that you can actually do that with. So.
So I wanted to ask a couple of questions about what people should consider, why they should consider an SBA loan over other traditional loans for their capital needs.
Okay. As I stated before, you have a higher value that we can go. So the lenders are more apt to go a higher value for you. And you have lower, you can be like skinnier when it comes to dollar amount. As I said, you can be like $1 for every dollar spent compared to the conventional side. And so those are the two major things. And because SBA is guaranteeing and backing part of the loan, then you have where banks will make exceptions. Where before they wouldn't make exceptions because it's got to fit in that nice little tight box.
Right. So another thing that I was having a discussion with somebody recently about this, and I'd love your opinion on it, is the banking regulations over the past 5 years have really tightened up. And so banks are not necessarily as free to lend as they were, sort of before the big recession that we had in 2008. So because of that, the restrictions have tightened up, money's not flowing as easily, and whereas people in your position may have gotten a loan, traditional bank loan 5 or 10 years ago, not the case now. So SBA loan is sort of the way to go because it's friendlier to a larger audience. Would you say that's accurate?
Yes and no. I would always say that, to be honest with you, if you could go conventional, you're going to find that you're going to get a lot lower interest rate. And it's going to be a lot more attractive payment for you. If you go SBA, it's because you want to go in with the least amount of money that you can put out there in order to get into the program. So I usually, to be honest with you, as a lender, I push people more towards the conventional side if they can afford it, because I can do, for my bank, I'm not saying all banks out there, but for my bank, I would do a non-loan origination fee for most of my clients.
Wow.
Whereas with SBA, you pay a 3% fee on the 75% backed, government back. And that's not that the bank is taking that. That's directly to the government.
Right, okay.
So,
okay, let's see. Tom says we can't take a HELOC and then loan the money to the bank. Sorry, loan it to the business, okay.
when you first start out, some people have taken out a home equity line of credit to start their business. But then I always recommend that once you get your business up and running, you would really want to get that back off of your home, because you, of course, as a CPA, you can probably talk a little bit more about what effects that would have with your taxes. And some businesses do start it that way. But I always highly recommend when you actually start making a profit, get it moved back over to the business side and free up your home.
And also to control the risk as well, because you don't want to have that home tied to a business. You know, you want to keep a division between your personal assets and business assets as much as possible. And if you need to lean on that a little bit in the beginning to get off the ground, you know, so be it. But to separate yourself from the risk of the business, get that personal asset out of there.
That would be a CPA question. He wants to know if you were to loan it to the business.
If you wanted to take the HELOC and loan it to the business, that would be considered probably a contribution from you as the owner. I mean, you could do a loan and then you would need to, you know, assess interest on it and pay yourself back interest, but probably the cleaner way would be for you to take cash, contribute it to the business. That's going to increase your equity, and then you personally just have the burden of paying back the HELOC. Then we've got, what percentage would you need to qualify for a conventional loan?
So that would depend on what type of conventional loan you want to go with. So if you're buying a building, 80% of the building, the loan to value on it is how much we can lend as a lender. If you had any types of accounts receivables, then it could be 80% of your accounts receivables, but of course that would be anything that's under 90 days for most banks. And then if you have equipment, they'll generally do 50%, but keep in mind your CPAs are very good on writing off the amount that you have and depreciating that asset, because so the banks usually go off of what they have on the taxes. Now you can do a business appraisal, but a business appraisal, remember, is $2,500. So. And, oh gosh, what was I going to say? Oh, I just had a thought and I lost it. I'll come back to it. Oh, I remember. Okay, so how do banks look at inventory as an item that's collateralized? So AR is worth 80% if it's under 90 days out, and equipment 50%. So what value does inventory get? So generally on accounts receivable, we're going to look at the aging report. And as I said, anything that's 90 days or less, we're going to go 80%. And that's pretty standard across the board with most banks. When it comes to equipment, you're looking at about 50%. And inventory? Inventory, you're at 50% as long as it's raw material or it's already made. In process, most banks will discount that and they won't use it. Okay. So that makes sense, though. I mean, so if you're a brewer and you've got bags of grain sitting around and you've got packaged goods sitting around and then you've got stuff in the tank, if you go broke, if you go belly up, then the bank is not going to take that work in process and finish brewing the beer. They're just going to take the packaged goods and they're going to take the grain and be able to sell that. So that can be collateralized, but the work in process, not. Cool. Okay. And keep in mind the magic number for you all is when you hit to 2 years. So once you're in 2 years, there are so many more loan products out there available to you besides SBA. So that's when the world will definitely open up, is when you get your businesses successfully running. And I believe we have a couple questions here. So who made beer while we were gone? Uh-oh. Wow.
These guys. I hear some babies.
Yeah. Hi.
Can you guys hear us?
Great.
Wonderful.
Awesome. Sorry for the delay.
I can bring back slides if you want.
Oh, we're fine on slides. However, though, we did miss everybody's questions, so if you had a question, if you can resend it to us, that would be great.
Yeah.
Third time's a charm. Thanks, John.
Let's see. Let's shift this way a
way,
little bit.
there we
Yeah. Okay. Okay. Yeah. Third time's the charm. Okay. So we were talking about kind of the differences in different types of loans. What kind of fees? If you could talk a little bit about the fees, the rates, and the terms.
So, wait 1 second. Justin has a question. So, on the interest rates for SBA loans, it's going to depend on the length of term you go and how long. And if you go with a 7A or 504. So, that's really going to depend. So, it can be anywhere from 5% to 7% depending on which one you go with. So, and you talked about the 1-to-1 and 1.25. Is that monthly payment to monthly cash flow? That is actually yearly. Very good question, Wyatt.
Question on the rates. Are SBA loans, you mentioned that 5 to 7 range, are they tied to prime in any way, or is it just kind of a flat rate? Does it float at all?
No, it does float, and it's based on what SBA sets for the month. So
Okay.
they're
So
actually
it floats,
right.
but it's not tied to prime.
That's correct.
Okay.
And then I believe somebody had asked earlier, what is the difference between conventional and through SBA? So an example of a conventional loan, you're looking at about 4.11% fixed right now, as compared to a 6% on a 25-year.
Okay.
Might want to type that in. Just in case there's some latecomers.
Yeah.
We're typing in some information about the differences in the rates between conventional loans and SBA loans. So Drew was asking about 7A versus 504.
Okay, so the 7A and the 504 are both using fixed assets, but remember they will always tie it to real estate if they have any opportunity to do so. And the only difference between the 7A and the 504 is the 7A you have only one loan, and the 504 you have two loans.
Yeah, for Wyatt, 1-to-1 principal to yearly cash flow or yearly loan payments to yearly cash flow.
So it's actually yearly loan payments with all of your expenses for the business. So it's everything added together for the year.
To cash flow.
Okay, that seems tight.
Actually, no, it's not tight. Lots of people actually make it. And believe it or not, there's companies out there that'll do 1.4. So just think when you get your business up and running, how successful you're going to be. So.
Yeah, so is it the debt covenant ratio? Is that the term that?
Debt service coverage.
Debt service coverage, yes.
Debt
So
service coverage.
debt service coverage is the idea of how much cash flow you're generating that's available to pay back loans. Right.
Yeah, that's correct.
Let's see. Okay, so we talked about fees, rates. Okay, terms for conventional loans versus SBA loans. What type of terms are we looking at?
We can cover that. That was the 10-year for non-real estate and 25 years for real estate.
Okay, so you get the longer terms if you can tie real estate to it.
That's correct.
Okay. Let's see. This is kind of a softer question, not necessarily on SBA loans in particular, but just what are the aspects of a good banking relationship that folks should be looking for as they're kind of filling out their suite of service providers?
What a lot of customers like to look for when they're looking for a banking relationship is, can the bank that you're working with take you to the next level? So yes, they're going to be able to take care of your immediate need now, but as you grow your company, are they going to be able to continue to take care of you? That way you're not going to have to go from bank to bank. You can build a relationship with a banker and continue to grow that with that banker.
So how do most people utilize their relationship with a banker? How do most business owners utilize that relationship? I think of, a lot of folks as individuals, before you start a business, your bank is just kind of a means to an end. It's where you deposit your money and take money out. And could you kind of flesh out what a real valuable banking relationship looks like and what resources a banker could provide that you don't see when you're just working as an individual?
Oh, absolutely. So everybody's very familiar with a checking account. That's pretty standard. And I'm sure everybody's familiar when you go to the store and you're using a Visa machine, you know that you have merchant services. That's pretty standard also. But some of the areas that the big companies actually look for is treasury management. So they're looking for, how do I wire money? How do I get products from overseas? How do I get my products locally? What is the fastest way I can collect money? So if you have vendors you're selling it to, like large grocery stores, if they're not paying with a check electronically, how are you getting that money directly to you? Are they wiring the funds? These are all treasury management things that happen on the back end.
Mm-hmm. Okay, so just more robust needs as a business evolves.
Right, and then there's also portals where you can actually set up portals so you can have employees assigned to certain things. And so like you can send your CPA where your CPA can only see everything that ties directly to your taxes, where maybe your manager can actually send payments directly electronically because that's the way you have them set up. So there's lots of facets of the banking.
Okay, great. And my next question was about collateral, but we touched on that a few minutes ago. I was wondering if you could give us maybe 3 of the biggest keys to loan application success.
Absolutely. So the first thing is to have a great business plan. So, and I'm going to type in a site that is really great for a business plan because I know you've already been working at it, but I don't know how many people know that you actually have a free site available to you. Let me find it here in my notes. Okay, so, and with this site that I'm going to send directly out to you, it's going to also, it has free counselors, and they work for SBA. So they can actually help you answer your questions and you don't have to pay anything for it. And they have great examples of business plans online. And then I'm going to give you a second website which actually talks about the different types of SBA government products that you have available to you. So I'll give you just 1 second and I'll let you do a little fill-in.
Okay. And actually this ties really well with the first homework assignment for this week, which is to go on the SBA site. I want you to get on there, poke around, see what resources are available through the SBA, not just for loans, but for everything. It's a wealth of information out there, and you would do yourself a real favor by understanding what resources are there. So the first homework assignment is to go on SBA.gov, and I have a series of questions that I would like you to find the answers to while you're there. But a lot of the questions deal with the loan aspect, but then also there are a lot of other resources available.
So then after you get your business plan together, the second thing is to make sure that your application is complete. Make sure that there's no blanks on it. If you have a question about it, make sure you're asking the person that's going to help fight that battle for you, because you want them to be their advocate, because they're the only one that's going to be able to talk to the underwriter, so you want them to advocate correctly for you and understand your business plan. And then the other thing is as you're going along through the process, when the underwriters are requesting something, you want to get that to them as soon as possible, because the faster you can get everything in and done, the faster everything will go smoothly for you.
Okay, great. So Chad, I was actually just going to ask how you guys have found SCORE as a resource. Like, have you used them? What's been your experience? So Chad says, you used SCORE, they were helpful, they seem to be an honest advocate. Awesome. So what part of the country are you in? Oh, Melly says Virginia. Awesome. Arlington, awesome. Okay. Anybody else who's used SCORE? Oh, okay. Oh, great. Okay, so tell us about your experience so was the advisor and mentor, those were 2 separate people or one? And then how did that relationship play out? What type of issues did they help you resolve? And then what have you seen, like success stories with SCORE? Have you had clients that have gone through and beefed up their business plan based on what they've seen there?
Absolutely. I've actually dealt with a lot of customers that have already had a business plan, and maybe they were struggling in their business plan and it really wasn't working the best that they could, and they were able to go to SCORE and actually get a better business plan, and they were already running in existence. So I noticed on here that somebody has a father that's helping out at SCORE. That's very nice. I like to see that. So.
Cool. And so, Chad, when you were working with the SBA, how many instances did you meet with them, and was it a prescribed, 4-week program, or did you meet with this person until you felt like all your questions had been answered? Oh, okay. So just twice, but they'll meet with you routinely. Is anybody out there currently working on an SBA loan application or a loan application of any kind? No? Okay. We have about 5 more minutes with Kathy, so let's see, because I was going to do a last call for questions, so get them in.
So the good question that you asked is it possible for a lender to sell your SBA loan to a servicer like they do mortgage, or do they need to because the government is helping guarantee? If you use a preferred lender, they will keep it. Like U.S. Bank does not. We are a preferred lender, so we do not ever move your contract anyplace else. We always keep it directly with us. So that's one of the other advantages of using a preferred lender. And then, so you're using Umpqua. They're a good bank. Mm-hmm. So.
They prefer lender?
I do not believe so. But they are a good bank.
Yeah. Awesome. What other questions do you guys have about loans in general? It doesn't have to be SBA specific. Have you run into any roadblocks, or if you've started the process, what's been the biggest challenge for you to get a package together? All right. Well,
and keep in mind, my contact information was up there, and a lot of people will call me and ask me questions, and that's perfectly fine. Because a lot of the loans I may do may not necessarily be just for you. It could be for your family member or friends. And so I don't advertise. It's all word of mouth, and that's the reason I'm more than willing to answer any questions. Yeah, so, and there is no stupid question.
That's the truth. And she's been a great resource, so definitely reach out. Let's see here. Do lenders have issues with raising an initial percentage from investors?
No, you can do up to a 10% seller carryback if that's what you're asking about. They usually like to see you put a little money in. So if you, with certain types of loans, you might be able to do like 5% where you do cash in and then 10% with an investor. So it just really depends on which bank you go through and the program they're trying to put you through on.
So how does a bank view someone who, puts a little bit of skin in the game versus somebody who's ponied up their retirement plan to contribute to the startup funds? Is there a difference in the bank's eyes on the credibility of?
It's a different even in SBA's eyes. They want to see that you have something that you put in yourself, not something that you've taken out of your home necessarily, or something that you've taken from, like a family member. But remember, you can get a gift from a family member, but they would need to write a letter saying that it is a gift and that they don't intend on you paying it back. Okay. So, and I believe we have a bunch of questions here. On price per square foot, there's, you can actually Google it, believe it or not, and it will tell you what the price per square foot is on the buildings in your area.
That's great.
I think he's complaining about it.
Oh, you don't like your price per square foot?
I don't really do.
Let's see, not having to have assets to obtain these loans.
Now remember, for Joe, they do like to have you have some type of asset, but remember these are uncollateralized loans on most SBA loans. So they will look at, possibly putting some type of lien on your home or to make up that collateralized that's a little bit less.
Can you talk about the process a little bit? Some of my clients have SBA loans, and in order to get the funds dispersed to them, they have to submit receipts for proof of purchase of equipment. So they submit receipts and then fill out a form that says, I bought a tank worth $30,000, and, please reimburse me for that. Is that a normal process?
That is, and the reason why they're doing that is because SBA, when they first came out with a lot of loans, people were trying to put things in where they just had cash that they spent on their own personal.
Mm-hmm.
So they did it to buy a personal TV, and then they said it was actually for the business TV. So that's why they have checks and balances now in place.
So people should expect to have cash out of pocket to actually buy something. If you had to put down money for a tank, for example, and then you submit that receipt, and then the bank reimburses you. Basically, they're holding inside your funds in a little account to the side, and then they would disperse it to your checking account, for example, as you submit those reimbursement receipts. Let's see. Okay, if I don't have a home, maybe I'm getting my terms mixed up.
Well, if you do not have a loan, if you do not have a home, you can still get a loan, but it's going to depend a lot on your business plan and what type of assets that you're going to have that you're going to start up with the business that you're going to actually take out on the loan.
So we're right at about time with Kathy this evening. So if you have other questions, feel free to type them in, and if I can't answer them, then I'll get back together with Kathy and we'll send out something to you that answers those questions. But yeah, thanks for being here.
And thanks for inviting me tonight, guys.
Thanks, Kathy.
I'm going to spend a couple minutes just wrapping up with you. Thanks, Kathy.
You're welcome. I'm listening now.
You want to come on in?
Yes, I'll join Maria, everyone. I'll sit in the back, though.
Just like the Wizard of Oz. Just
I think she should be in the front, guys. Tell her.
Oh, they say, thanks, Kathy.
You're welcome.
Will the slide deck be uploaded? Yes, the slides are
Tonight.
up
I'll do
there.
it tonight.
Oh, tonight they will. Okay. Okay. Yeah, so I wanted to kind of go through the homework a little bit and just put some final points on that. I think that the SBA, okay, let's see here. Drew says, wow, that reimbursement sounds awful. So even if you're making big equipment purchases, you have to have cash in hand.
Actually, you can do an equipment finance loan, everyone. And that gets you away from the SBA. It's a lot simpler, up to $150,000, and most banks don't make you show financials.
Okay, let me write that in. Okay, Kathy says another option
Is equipment finance.
is equipment finance loans. Simpler non-SBA loan, simpler process. Good rate. And they would approach just a traditional bank for that. Okay.
Some of the equipment people are loaning.
What's the dollar?
People are
Oh, that's right, yeah.
up to $150,000 usually for their financials. But they like to see you in business for at least 2 years.
Okay, let's see. Most lenders for equipment finance loans like to see you in business for at least 2 years.
So tiny nano to, can you even get 7-barrel for that?
And don't forget, some vendors carry their own loans.
Right.
I know that. Because
Okay.
I need to know that too.
Yeah, thank you. So Kathy was just reminding me that some vendors carry their own loans. So think of it like you buy a car from a car dealership and the dealership finances your car, same type of thing. If you're going to buy a brew house, your manufacturer could finance that as well, depending on the vendor. It doesn't always work out that way. Okay, so cash flow, this homework assignment is going to be pretty meaty. Depending on your love or hate for accounting, it might work to your advantage or not. But hopefully with the film, with the recorded video that you're going to watch and the setup that I give you on tab 1 for that exercise, you'll be able to put the pieces together. One of the things that I love about accounting is that it's kind of like Jenga, or no, not Jenga. What's the one? What's the word game, the numbers game where you have to put numbers in the right places? I'm drawing a blank. But it's like
Sudoku.
Sudoku. Yes, thank you, Don. Thank you, Drew. Thank you, Tetris, and everybody else. Anyway, so it's like this puzzle, and you have to get all the pieces in the right places. And building a cash flow statement is like playing a game of Sudoku. Basically, you're looking at changes period over period on the balance sheet and integrating them into the cash flow statement. It starts with your net income from the profit and loss statement, and then you work your way down through a series of adjustments to your ending cash balance. And that ending cash balance is always going to tie to the cash balance on your balance sheet for the end of the statement. So if you have your P&L, you've got your starting point, and if you have your balance sheet, you've got your ending point, and then it's just a matter of putting those pieces together. So it could be a fun exercise or pure torture, but I hope it's the former.
Maybe give it a little half to get there.
Yeah. Oh no, John, it'll be great. You're gonna love it. Let's see. Oh, and to recap on,
two, right?
yes, that is exercise number 2. That's right. Yay! Yes, yay! And then the homework exercise number 1, that's the exploration on SBA.gov. So hopefully you'll have a chance there to poke around, find resources that are going to be applicable for your business. Any questions for loans or me or cash flow or accounting, whatever that you want to talk about in these last few minutes?
I should mention that the technical problem that we're having in here today is we're using a different studio that's all on wireless, and we've learned that wireless knocks out Canvas. So after tonight, we're back in the lovely studio with director's chairs, which doesn't have that problem anymore.
Well, having cash from a Kickstarter help to secure a loan with banks? I don't know the answer to that at all, because Kickstarter is a pretty new idea, and I haven't ever been in a situation where one of my clients has gone that route. I would think, my gut instinct is that, you know, if you have money pledged from Kickstarter, well, that's cash is cash, and so, you know, once it's cash, that's an asset, and cash is going to be viewed the same way as long as you have it under your control. Now, that's going to be the real caveat. Like, could you go to a bank if you have a Kickstarter underway and you have, let's say the goal is, you know, we're going to raise, I don't know, $50,000, and if we don't meet our goal, then nobody's contribution counts. Then you could not go to a bank with a contingent pledge. But if you make your goal, then you've got cash in hand, and that's a pure asset. And yeah, then you've got $50,000 more. You can go to the bank and say, I've got this money to put up. Actually, later in the course for this section, we're going to do a video about Kickstarter as well. So that'll be up either next week or the week after. But does that make sense, that difference between a contingent loan and then one that's truly within your possession?
Well, Jason has a question about charts of accounts for breweries.
Okay, let's see. I want to just touch on Tom's point. They would have to take into account whatever you promise to deliver to the people supporting your kids. Yeah, I mean, so I think most people with Kickstarter, it's a nominal thank you gift. So, you know, if you have a $100 contribution and people get a T-shirt in exchange, then you would have to take $100 minus the cost of the T-shirt is what you have raised, essentially. Okay, blah, 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 blah. Let's see. Not blah, blah, blah in a bad way. Let's see. Will we review charts of accounts for breweries at some point? That hasn't been on the agenda, but it's something that we could discuss. You guys haven't discussed it yet. Okay. Yes, I will find a way to fit that in. Craftfund.com, Kickstarter for breweries. Awesome. Yeah, and then there's also alternative sources of funding such as Craft3, which is a sort of, it's not a bank and it's not a government agency, it's an alternative, and we're going to talk about that in a later course as well.
Don't age your beer.
Yeah.
Do not put things in barrels.
I'll tell you. Okay, so because if you put things in barrels, then that beer is going to just be sitting on your balance sheet as inventory until it's a finished product, which could take a really long time. So yeah, don't age because there's costs associated with carrying inventory. Just standard accounting rules, what counts as an asset. Okay, a couple things there. So creative accounting is a term that makes me a little nervous as a CPA. Yeah, I mean, you have to play by the rules. You can't twist numbers. So you do have to, you know, comply with standard accounting rules. I guess one thing that you could think about is the method of depreciation that you choose, because there are different ways that different methods that you can choose to depreciate fixed assets. Most small businesses tend to follow what is reported on their tax return. So on your tax return, you might select what's called Section 179, and that's a code section allowing you to write off 100% of a new asset purchase in the first year. So the idea behind depreciation is that an asset has a useful life. Let's say a computer has a useful life of 5 years. So you take a portion of that computer's cost as depreciation every year until that useful life is used up. So that's sort of how the concept works. But then the government has put into place this Code Section 179, which has been around since early 2000s, and it allows you to take the full purchase price and write that all off as an expense in the first year. And the reason that's beneficial for tax purposes is that it reduces your income and therefore reduces your tax liability. Most small businesses will keep their books, their book accounting, the same as what's reported on their tax return, and there's nothing wrong with that. The more sophisticated that a business becomes, they will probably choose a different method for their book depreciation. So another method which doesn't take into account Section 179 is called makers, and basically that is taking a more measured approach of taking just a little bit at a time over an asset's useful life. So that being said, depending on the method of depreciation that's on your books, depreciation gets added back to your cash flow statement. So the more depreciation that's on your books, when you add that back to your cash flow, that's going to increase your cash flow. So, crash course on depreciation there. Okay, guys, well, that's it for tonight, and we will see you next week. Thank you.
Nice to see you guys.
Thanks.
This is fun.